Banks play a huge role in a country's economic stability and sustainability. That's general knowledge. But have you ever taken the time to actually understand how their systems work? If you haven't, then you're probably oblivious to the pros and cons of banking. Don't fret. Investops is here to educate you. But before that, go ahead and click that like button. It helps the channel bring more people to our little bubble. While you're at it, click the bell icon to subscribe to this channel and stay on the loop with the latest videos on personal finance and investments. Number 1. It's not good to keep your money in the bank for a long time. Let me ask you, how much interest rates does your bank give for the deposits you make on your savings account? For traditional accounts, probably 0.1% annually at most. For high-yield accounts, probably 0.8% at most. That's a very small amount. Well, that's logical, seeing that the bank doesn't get any incentives in giving you higher interest rates, especially not under financial stress. Interest rates are affected mostly by two things: the supply and demand of credit and inflation. Let's discuss the supply and demand of credit first. The more money banks can lend, the more money is available for the public to borrow. If the deposit becomes significantly more than the money being borrowed from the bank, the interest rates will go lower. That is why people have experienced all-time lows in rates during the COVID-19 pandemic. People have been saving up money more than they are borrowing or spending. Second, inflation. Usually, the higher the inflation rate is, the more interests are likely to rise. But this was not the case amid the COVID-19 pandemic. Again, people were not borrowing money, so the banks could not afford to give out huge returns. But even outside financial stress, you can't enjoy high returns since the number of deposits is generally more than the number of loans. So keeping your money in the bank for a long time is not a good idea. Think of a bank like a quick stopover during a 5-hour road trip, rather than the destination. Number 2. You can make more money by borrowing from the bank. If the bank is a quick stopover, then where is the destination? The answer is investments. But I don't have any money, what should I do? Well, since we have established what your bank cannot do for you, which is to give a high ROI, then it's better to take advantage of what your bank can do for you, which is to lend you money. You can make more money borrowing from the bank than stashing it away in your savings account if you invest it in stocks, businesses, properties, and other income-generating assets like what most rich people do. You always hear about the net worth of people like Elon Musk, Jeff Bezos, Mark Zuckerberg, or Warren Buffett reaching the billions. But that doesn't mean that's what they have in their bank accounts. Most of the amounts reported in the news are stored in illiquid assets, contrary to what most people think. Number 3. Banks don't offer the same rates to all borrowers. While it is advantageous to borrow money from the bank, it's not equally advantageous. Depending on your financial status, you could be paying your loans at a higher or lower rate compared to others, which would make sense when you realize that banks are still businesses at the end of the day. They will not risk offering better terms to those who are more likely to default on their loans and will give better terms to more valuable clients instead. Basically, you have to do better financially to get better treatment. Sad, but unfortunately true. Number 4. A lot of the money in the banks are not in cash form. For a bank to generate money and continue operating, it has to lend, then collect payments with interest. There is no point letting the money sit in cobwebs because they don't get profits from that as a business. However, loans are paid in a span of several years, not in just a year. There are also loans that default, leaving the banks no choice but to take properties as payment. This just shows how a lot of the money in the banks are just numbers on a screen. They are not readily available in cash form. Those numbers are taken from the amount of money they expect to have in the future and the value of the property seized by the banks. If all of us were to withdraw our money at the same time, the banks would not be able to give all of us our money there and then. Number 5. Credit cards are double-edged weapons made by banks. A credit card is a wonderful piece of plastic. Not only do you get to enjoy perks and bonuses because of it, you can also establish a good borrowing reputation. Building a good credit score through credit card transactions is very useful, especially when you want banks to put their faith in you. However, it's not all rainbows. If you are not careful enough, you can fall into the trap that banks have set for you as soon as they gave you your first credit card. Swiping it left and right might be exciting, but paying for it is definitely not. So, if you don't want to drown in credit card debt, make sure that you stay on top of your payments. Better yet, make sure to swipe only for what you can pay for. Don't let your bank win this game of wits. I've covered a fair number of points about the way banks work in this video, but there are still lots to talk about when it comes to banking. If you want more videos like this one, comment down below and click the bell icon to be the first to know when new videos on personal finance and investments go up. Go ahead and give this video a like too if you love this type of content. Thanks for watching, and until the next video!